Hey, welcome to Share Council, and thank you for showing interest in us. We're super happy to see you, and happy that you clicked on the intro call. So you can book an intro call with us, or you can watch this video and you see exactly what we explain during the intro call. Really hope you get enough information out of this. If afterwards you would have questions, please know how to find us. Welcome to our webinar today, our basically our lunch break on employee participation. I'm gonna try and explain to you a few things today. I'll do a short intro on who we are and what you're hearing right now. Then I'll give you some of the meat of employee participation, more on the information side and the theory side. Then I'll give you a short part on international employee participation, and then I'll run you through how you can use platforms and such for setting this up and running your employee participation. So employee participation, we run it as Share Council on a platform. It's Share Council is an online platform for employee participation. We have about 200 companies on our platform. We have about 20,000 users and about 1.6 million, a billion, sorry, in assets registered on our platform, and trusted by quite some of the well-known brands. One thing I would like to share always with everybody: we are a mission-driven company. We're here to try and closing the capital wealth gap by making every SME employee co-owner of the company they work for. Mind you, we focus on Europe. It's 137 million SME employees in Europe. And we are concerned by the fact that 63% of the capital in Europe is held by 10% of the population. And hopefully, by making every SME employee in Europe co-owner of the business they work for, we can move that paradigm. Now, into the information, into the theory of co-ownership. And I'm immediately going to put it in there. Yes, we run employee participation on our platform, and I'm explaining you a lot about it, and we know a lot about it. But in general, companies that use our platform or set up employee participation actually look at a wider variety of co-ownership of their business. And I'm going to explain to you here what it is, how co-ownership works. You have an employee focus with co-ownership. That employee focus is here, you see on the left-hand side, under number 1, is really on employee engagement. How can we maximize the engagement of the employee, the feel with the company, and increase the output? Basically, that's on the business level what you want to do with this. But also, how can we, for instance, have a hiring advantage? You see on the number 2, where if you have a hiring advantage with offering something extra to an employee, you don't only attract talent, but it's also proven that you keep that talent on board. That's the employee focus of co-ownership. Then also, next to that, you can use the same mechanisms for community focus. For instance, you might want to have an exit as a founder of the company. You don't want to sell to a VC or something else. No, you want to sell to your employees. Exit to employees, what we call that. It became really big in the last 10 years in the UK, and is now slowly but surely also moving over to the European mainland via employee ownership trusts. Furthermore, on community focus, you have really the community buildings, which Share Council does as well. At Share Council, 100% of the company is is owned by a foundation, is given out in depository receipts, and the community owning this depository receipts is not only the employees, it's not only me as a founder, but it's also all the investors. It's also all the clients. If you become a client of Share Council, you immediately, by your first invoice, become co-owner of the platform, and even our suppliers co-own Share Council. And it's shown that if you have all your stakeholders co-owning the business, you have a more economic stability in the market and a more economic growth trajectory of your company. And then the third one, which you do with co-ownership, is capital focus. It could be, as in under number 5, a liquidity solution. That's really pay with equity. So, for instance, pay your suppliers with equity or pay others with equity. Or under number 6, raising capital, which could also be done by equity, selling your shares to others, or it could be borrowing money through bonds or other loans. So these are the three main pillars: employee focus, community focus, and capital focus. And co-ownership works for all three of these. Now, we have a few fantastic examples in this, and one I always like to share is Handpicked Agencies, a company from the south of the Netherlands. They actually buy and merge digital agencies. Well, interestingly enough, what they do is they buy a digital agency, they keep the local name, the local brand, the local team, the true company, and they build up this network of local companies. Interestingly enough, Handpicked Agency says, okay, we do want to have the advantage of the fact that we have 273 employees, that we have this bigger organization. And what they decided to do, and they presented this on super cool on a festival that they organized. They wanted to make everybody co-owner of the top group of handpicked agencies. And on a festival, everybody got a message. You can look now. You co-own handpicked agencies. And that is really a community building that you can do. And in that way, you have a community built out of, in this case, little pods throughout the Netherlands. To do these kind of things, to go for these three different focus groups, there are basically 6 financial instruments you can use. And they're organized in 3 groups. You have the group of true ownership, someone really owning part of the company, having paid for it and received an ownership in the company, which can be depository receipts given out by a foundation, or it can be economic ownership rights, which is basically the same as depository receipts. It's just you don't need a foundation to hand them out, which is super helpful because then you don't have to go to a notary to execute it. Doesn't work for everybody. I immediately have to say that, although I do have a very nice example also in this presentation further down of a bigger company in the Netherlands using this economic ownership rights structure to make every employee truly co-owner and never needing to go to the notary. Then you have the middle, it's not true ownership. Under that, you have options and stock appreciation rights. Options is basically, we promise you that you can buy shares in the future for a price we agree on today. So you're not an owner yet today. You haven't bought anything today. You have the promise that you're allowed to buy. You have the right to buy something in the future. The stock appreciation rights is as much as, okay, we pretend as if you're a co-owner of the business. We pretend as if you have 10 shares. You don't have them, you'll never get them, but we pretend as if you have them. And we knew what the price of those shares were when you got them. And we know what the price of the share is when we sell the company. Well, the difference of that is then paid out to you. Although there is income tax withheld from that because it's truly seen as a salary, as a bonus. And then you have the third column, which is loans, convertible loan agreements. So that's a loan money borrowed to the company, which can convert later on into equity, or bonds, which also could be convertible bonds, but bonds are often used. Okay, someone borrows money to the company, receives a fixed interest rate on that, or fixed interest on that constantly over a longer period of time, for instance, 10 years. And someone can sell that bond to someone else, and then that other person receives that interest. Well, those things, this covers it, all of it. And interestingly enough, we have a super cool client, the Sharing Group, who uses all these things, who also is on the employee focus, they're on the community focus, and they're on the capital focus. And for that, they needed to use all these different instruments to really make it work. They mainly use the depository receipts and bonds. Depository receipts to make people co-owner, employees, for instance, but even users of their products. The Sharing Group has a car sharing company. They have a domain name registering company. They have energy focused companies. It's a wide range of companies, and the clients of all these companies, the end users of all these companies, can actually save up points throughout the year by using their products, and these points can be converted into true shares. Well, they call them good shares. Super interesting model where they really build a community with every stakeholder of their company. And lastly, they raise capital 4 times a year with bonds, and really figured out how to use this whole wide scheme over one product as co-ownership. Now, why do you, for the rest, for employee participation, have all these different instruments? Well, most of the companies have employee participation to really increase the engagement of the employee, to increase the loyalty, to increase the consciousness of the employee, what to do to make the company work, make sure that they earn more money, make sure there are lower costs, make sure that the efficiency is high, that the margin is there, and really make sure that the company is set up for success for the coming years, not for the coming week or coming month. That's why you go into employee participation, most companies at least. If you want to have the maximum result of employee engagement, you go to the furthest of the right here on this slide, to true ownership. But that is not always possible, because if an employee wants to become, or if you want to have an employee becoming true co-owner of the company, that employee has to buy those shares. If you as a company give them to the employee, then it's seen as a salary. So you as a company have to pay the income taxes over that. It will cost on both sides. It will cost money. However you do it, if you give it to the employee or if the employee buys themselves, in both cases, there is some kind of liquidity needed somewhere. And that's not always there. If it's not there, then you got to move to the left. So you have true ownership. That's here number 4 and 5. But you can also go to number 2 and 3, for instance, which is more an agreement. As I said, you have options and SAR, which both is an agreement. Options is agreement that you can buy something later on for a price we decide on today. And the stock appreciation rights is nothing more than an agreement that you can get some kind of bonification, a bonus, based on the increase of the value of shares. The good thing about an agreement is you don't already own it when you get the agreement. So you don't immediately have to pay for it. And that is a very nice way of promising someone to really grow with the value of the company without needing to do heavy investment upfront. But yeah, the disadvantage, it does have a lower engagement than that true ownership. That's a trade-off that you're constantly in. And then the lowest engagement is not 0, but the lowest of these 5 options is basically the convertible loans or the bonds. Bonds are actually fairly often still used by consultancy firms, where they say, okay, you as a manager, you're allowed to put your bonus of 10K back into the company, and you get a fixed interest rate over that for the coming 5 years. That's a really nice way and a fairly safe way of earning extra money from the company without needing to pay extra taxes over that. Now, before I'm going on to the international part, I'm going to show you 3 structures: options, the foundation structure, and stock appreciation rights, more of what it looks like, to really quickly give you an idea. Okay, this is what it more or less does. It might look complicated because there's a lot of lines on the picture, but you can receive this a presentation afterwards to look into it, or you just pause this recording and you can go through it later on. But so an option, as I said, it's nothing more than a promise you can buy something in the future for a price we agree on today. The one that's giving out the option is often the operating company whom the employee is working for. That option is almost always on the depository receipt of a share. The reason that you do that is because a depository receipt is easily shareable and tradable between employees, or from the company to an employee, or anything else, just movable without constantly needing to go to a notary for a notary deed to move the underlying share. That's why you do this. And it's a beautiful construct for the rest, because with the new regulations that are in the Netherlands, and actually it's coming up more and more throughout Europe, there is way more power with the employee to decide, when can we execute the option? When do I need to pay taxes over this? And can I extend the taxes to the moment that I actually receiving cash for what I'm owning here, what I'm gaining, or what I'm selling at a certain moment? So whenever an employee is not able to buy a depository receipt because they don't have enough money, or whenever the company is not allowed or not able to give a depository receipt to the employee because the company does not have the money to pay the taxes, we always advise go to options, because that gives a beautiful fiscal structure for the employee and gives way more power to the individual, to the employee, of when to execute things and to minimize the fiscal consequences. Then you have a simple foundation structure. We call it stock structure because that foundation used for this is the Dutch foundation, which is Stichting Administratiekantoor. And that it's nothing more than a foundation that holds shares and can give out depository receipts, tickets on these shares. What you see here is a lot of lines. I agree with that. The structure is actually pretty straightforward. A foundation owns shares, gives depository receipts on those shares back to the company, and that company can sell those depository receipts to employees or management, which is also employees, but often has a little bit of a different group, different status, or investors. Theoretically, you can also sell these depository receipts to suppliers or clients, and that's what Share Council does. Share Council, by the way, in this picture, would be a little bit different. That operating company would have only one arrow going out and only to the foundation, because the foundation, in the case of Share Council, owns 100% of the company. Myself, as well as the founder, I own depository receipts of Share Council because it makes it way easier to move those things around. And then the third one I wanted to show you more in a picture form is the stock appreciation right structure. That's the easiest of the three, actually. It really just is an agreement. Okay, we pretend as if you have shares. On a platform, we can register, wherever we do, we can register. You have 100 shares. And if they increase 10% in value, then you get that increase in value paid out in cash. But before we can pay it out in cash as a company, we need to withhold your income taxes off that. It's basically your salary taxes on that. That's what the stock appreciation right structure does. And we see often combinations of these three. That's why I showed them. Well, there's a fourth one, which looks very much like the foundation structure, which I explained already before, which is the economic ownership rights. And for that, I actually have a nice example. And it's the company Intermax Group, which has about 140 employees participating in the ownership of that company. And they do that via economic ownership right structure. They did not need to set up a foundation. For them, it was way easier. They had an operating company already. They already had a holding above that operating company. And that holding actually gave out the economic ownership rights on the shares that it held in the operating company. And these employees now co-own that operating company. They co-own the business they're working for, that they put all their time and energy in, and they receive the dividends on that. It's a fantastic combination. It really shows that a bigger SME and a well-known company can set this up without notary deeds, without needing any difficult restructuring or anything. Set up employee participation, still make employees truly co-owner of the business. Now, before I'm going to the last part, how you can do this on a platform, I'm going to show you, okay, what is this internationally meaning? And internationally meaning in our case is meaning Europe. We focus on Europe. And we did some research already a few years ago for what is actually missing in Europe. And it still, unfortunately, is missing today. It's missing in Europe the ease of setup of an employee participation scheme, which you see on the number one. Europe has a complicated regulation. And it doesn't mean that Europe as a whole has a complicated regulation. It even goes more into number two, standard of legal structure. There is no standard legal structure for employee participation European-wide. Every country has its own preference. And that means that if you are a company in multiple countries in Europe, and a lot of them are, it becomes pretty difficult to set this up. And even if you are only in one company, then still you run into that lack of ease of transfer of ownership. And that lack of ease of transferring is often because of the need of notaries, notary deeds. And then if you're only in one company, in one country active, you still have that lack of central knowledge point for SMEs, how employee ownership actually works, what you can do. I find it mind-boggling. You still can't find one location where all the knowledge is gathered about how to set up employee participation. And then the fifth one is that there is really a lack of an affordable legal structuring for SMEs in Europe. And mind you, again, this is all for SMEs. If you're a big corporation, you see that there's a lot of advisors and others you can hire to set up these kind of things. But the SMEs are really left behind in this whole structuring. So that's where Share Council dives into, and that's on the right written. You can read this later on. I won't dive too much into that, but these are five very important missing links in Europe, and exactly what we have been focusing on to make that easier. By giving the 6 different types of ownership, by standardization, by the ease of transferring, giving a huge knowledge base, and supplying an affordable structure. We see hence more and more companies internationally, and right now, for instance, Polish and Czechian companies coming to us to set up their employee participation through the structures that we use in the Netherlands. So they use the Dutch foundation structure for their company in their country to make it really easy to make their employees, and often even others like investors or suppliers, co-owner of the business. And for that, it might be, it probably is clear to everybody, but we can help you in doing this, in setting up that foundation structure for the international companies, even having address registration, having a dedicated company official, having a chamber of commerce handling by us. And for everybody with all those structures, you can use our platform easily to make people co-owner, to increase your engagement, to really ease and easily execute transactions, to pay out dividends, set up loan structures, or calculate interests. And now I'm going to the last part, and I'm going to take just a few minutes to go through this of what a platform can guide you in setting this up. We have a whole onboarding process for this, for instance. And what we try to do is really guide you through each step of choosing your co-ownership structures, choosing in which structures you want to really have people participate, restructure if needed your current legal structure of the company, and really then start building up the employee participation or even any participation setup in this. On the platform, you'll see your own dashboard, and you'll see different things, for instance, bulletin boards, ownership overviews. Participants themselves can see their own transactions, their own trades. You have gazillions of settings within the platform to see what can happen and how you can pay out dividends and such. Every participant has their own overview in their own wallets, how they build up their vesting structures, which is, by the way, whatever platform you use for this, these are some of the big add-ons that a platform delivers you on your employee participation and especially your employee engagement. The better you can keep your employee informed and up to date with their employee participation, the higher the engagement. Proven on all sides. You can show that in different views. And of course, platforms give you a super easy way of account setup that you can say, hey, employee, you are responsible for keeping everything up to date for your addresses, your bank information, and not only your employee, but any of the participators you have in your company. Where if it's a good platform, it even offers you to register entities, as in operating companies, foundations, private holdings, and such, to make sure you really can assign the co-ownership to the right entities. And of course, security is a high one. Your two-factor authentication should be active. We even demand that, by the way, because often these platforms gather so much private data that the risk of someone breaking in and taking that long and having a big leak are way too high. And if you're really good, then you can yourself even toggle on and off what kind of notifications you want to receive and how much up to date you want to stay with this. Then the last part of this, also going platform wise, is valuation. For employee participation, you always need valuation when you're speaking about true ownership? Well, in our case, in Shareholders' case, 90% of those 200 clients, 200 plus clients that we have is using true ownership in some form. So 90% of those clients needed to have some kind of valuation because the tax authorities want to see how much value you transferred to the employee when they started participating. And the tax authorities then say, okay, it has to be a market value. Well, what the heck is a market value of your SME company? It's difficult to see. You basically have three options. You can either do it yourself, download, for instance, on our knowledge base, the Excel sheets, and you do a discounted cash flow calculation yourself. Second is you use an integrated tool, and you get back to platforms again. In this case, Equidom, which is by far the biggest tool worldwide to do valuations. They have about 160,000 valuations, and they can even give you comparisons to other likewise companies, either within your region or even extending your region. See, okay, what are the valuations there? So they give you a discounted cash flow methodology, including comparisons. Or the third one is someone who does this for you, which would be a registered valuator. It might go without saying that the cheapest, in cash wise at least, is to do it yourself. Then you go to an online platform like Equidom, and the most expensive one is having a registered valuator. Of course, the debate is how expensive is it that you do it yourself in your own time and figuring this one out. What we see most clients doing is they either start with their own estimation on the valuation and then use Equidom year over year to really set up that recalculation via discounted cash flow methodology with a whole report every year printed out by Equidom. Or what we see them do if they are too uncertain about their own capacity to really give a good first guesstimate, they go to a registered valuator once and then reissue their valuation year over year with Equidom. That's what we see most people do. If you want to be 100% sure that tax authorities agree with you on your valuation, you eventually send an email to the tax authority saying, hey, we think this is the valuation for this year and the employees can buy pieces for this much. Do you agree, yes or no? If they agree, then you know 100% sure that you're never in fault of for which price you sold them. It's not always as obvious to start emailing with tax authorities. The biggest disadvantage is they take quite some time to respond, and quite some time is 5 to 6 months, unless you have your personal tax authority connection. But we do not know the SMEs that actually do. You need to go above a certain threshold to have personal contact with the tax authorities. Well, I really hope that this gave some good insight on how employee participation works, what is important, what the value is of it to do it, and how it's wider than just employee participation. It fairly quickly and easily opens the door to also community focus and even capital raising focus. I hope I also was able to explain to you what the buildup of it is, what the choices are that you have to set up employee participation. But I hope you also understood that you don't per se have to make a choice. You can also use multiple employee participation schemes next to each other, which used to be unlikely back in the day. But now with platforms that basically make the administration so easy, yeah, there's basically nothing holding you back from using those variation tools, a variety of tools. Please do know you're in good company to set up employee participation and really build a trusted community around your business. If you have any further questions, please let us know and please send us whatever you would like to know. I hope you have a good afternoon. I hope there was a good lunch break for you, and thank you for listening in. Bye.